Welcome to the daily update. This is being prepared Wednesday, September 7th, where we'll look at the action in the market today and then see how things look for Thursday, September 8th. And I triple checked the microphone setting before I started recording. So hopefully, even though the sound isn't all that great now, at least it should be better than yesterday's video. But we had a pretty nice bounce. Now, is it just a bounce? Is this the beginning of an upward move? My assessment of things right now is that we just kind of have to treat this as a bounce. We were not necessarily climactic on the downside. We were oversold on the short term, and that's probably where we're bouncing from. It's just we went down too far, too fast in the short term, and we're just seeing a little bit of a bounce back from that. Now, that could always morph into something else. But all we can go with right now is what we see, and our technical picture is still pretty much negative across the board. So let's go back and talk about what happened on Wednesday. At the open, we had a higher open, and then prices climbed all the way to R1, and that should be 39.38. Sorry about that little typo there. No, we're not at 29.38. We didn't drop that far. As the day went on, buying then pushed prices even higher to above R2 at 39.68. So no, we didn't have a 1,000-point move in the S&P there. Going into the close, we were just slightly off of the high. We were up 1.83%, a pretty nice little bounce. Volume was actually slightly above average. Now that folks are coming back, school is starting, vacations are pretty much over now. We're seeing volume picking up a little bit, but our technicals are still negative overall. We're not seeing a lot of real confirmation. Now, this could continue, and we might see some more strength coming in, but we kind of have to be real suspect right now with the bounce that we saw on Wednesday, because we're really fixated on inflation and interest rates that are producing growth concerns. That's the overall scenario of the stock market right now. We do have the whole list of geopolitical concerns, and of course, the situation with the pipeline in Europe. Of course, depending on what news source you use, it was often referred, not often, one person from the administration referred to it as the Nord Stream pipeline. So yeah, we got to get that under control if you're going to buy some clothes. We do have earnings that are being released kind of on a company by company basis. And then the whole recession debate, as well as some Fed speak, which did come out on Wednesday. And I'll go over that briefly. What are some comments? Was this only an oversold bounce? Right now, we kind of have to treat it that way. We haven't switched over to looking positive with most of our indicators. We haven't hit any kind of a real significant bottom. We did come down to support, and we've bounced up off of that, and that is positive. And that might lead to something. But right now, we have to evaluate what we see. The headwinds that have been hitting stocks over the last few weeks, pretty much ever since the big speech came out in Jackson, Wyoming, they subsided a bit on Wednesday, and that gave room for stocks to go higher. Please be reminded that by the time you listen to this, this will likely be old news, but the European Central Bank will be meeting on Thursday concerning interest rates. So we'll be keeping an eye on that. And the support that we hit just at about 3,900, as well as that trend line that I've been talking about, it's held up so far, but now we have to ask, can that continue? Our rotation, setups, positive scenarios, those are still on hold, and we're still wondering if we continue to fall, will new signals be generated? And here's some of the hawkish speech. That's kind of hard to say over and over. And I thought Nordstrom was difficult. The Fed chair, Bernard, indicated that rates will need to rise further. And then Mester, who we quoted that person last week, who's also a voter, reiterated the same comments that she made last week, where we need to take rates to a more restrictive level, and she doesn't anticipate a rate cut in 2023. Now, this is not the Fed chair, but this is a voter on the FOMC, so we still want to be able to, or we still have to pay attention to them. We still have the 10 to the 2 and the 10 to the 5 yield curves are inverted, and interest rates and the dollar, they're going in pretty inverse relationship mode right now with their negative or inverse correlation. I took oil off of here because oil's been kind of following stocks a little bit more closely. And I'll show you that chart. Sentiment, it actually ticked up a little bit, believe it or not. This is what's interesting. And this is one of the reasons why we have to be suspicious of this bounce, is because people didn't freak out. And to get any kind of a meaningful bounce that lasts for an extended period of time, we have to have a bit of a washout first. And everything has to be pointing negative. We did bounce up off of support. And like I said, that could change, but we're not seeing that from a sentiment standpoint right now. We had the weekly MBA mortgage applications index came out, and that was down 0.8%. And we've been seeing a decline week over week as interest rates are going up. Real estate is still going up. People are finding it very hard to buy new homes or to refinance. And so the number of people that are trying to get mortgages has been decreasing. And then the trade deficit narrowed to 70.6 billion. They expected it to be down 70.2 billion. So and neither one of these are real market movers, but they still give us a gauge of what's going on in the economy. So that's why we pay attention to them. Our trend is negative. It's actually weakening a little bit. It had been getting a little bit stronger as we were going down, but with the up day, the ADX has turned over slightly, but it's still above 20. I've switched the positive back over to let me try saying that again. I've switched the bias back over to positive because we had a pretty solid up day. That's just one day though. Our momentum, I'm switching over to mixed as well as negative, because we could easily wear off this short-term oversold condition and then start going down even more. So let's look at today's session. Sentiment is still not all that bad. It's in the fear category, but it's not giving us an extreme reading currently. And here's the historical chart, which when we're in the middle, I don't really focus on this chart all that much. Here's the latest RIDEX bear to bull ratio, and we're pretty much midpoint right now. This is actually a couple of days old. We're not spiking up, showing excessive fear, and we're not really low, showing excessive optimism at this time. So we're kind of in the middle. Here's some IsabelNet charts. This just compares the average midterm year, which is what we're in right now. That's the light blue line here, with an average non-election year. And there's a lot of headwinds too. There's a lot of things going on. There's accusations, there's promises being made, where after the election is over, the markets tend to breathe a sigh of relief and then go higher, but it can be a pretty bumpy ride up until then. And here we are into September, where this typically can be more of a weaker time frame for the markets. Then we have discretionary investor positioning. Now, this just means that you as an individual investor, you can pick, well, I want to buy some Amazon. Oh, I want to get over into some Bitcoin. Oh, it just means you have the ability to buy what you think is a good investment at any particular time. It's not the discretionary sector. And they're just saying how this type of positioning is well below levels that are implied by the current readings of growth. And we look at the dark green line here. This is where people are not really getting into a lot of these different types of investments as the ISM has been coming down. People are getting more defensive and trying to get into stocks that might either not lose as much or will hold up a little better if the market continues to fall. We also have, this is debt allocation. These are people buying bonds. That's what debt is. And it bottomed out earlier and we've been coming back up. It's still really low, but we are seeing folks starting to get back into bonds. But bonds have been hitting some real headwinds themselves lately. This is a chart from JP Morgan just showing how the light blue line here, this is CPI, and it's just been going up and up and up. And that's the official number. If you look at the non-official numbers, this line would be much, much higher. But they think that with the price of oil coming down, and they're projecting it to go down even more, that is going to bring the CPI down as well. So we'll just have to see if it plays out that way. Here's our current technical overbought, oversold composite where, and this is also a little bit older chart where we're down into the 30 range. We're low and this is negative, but we're not necessarily giving an excessively negative reading right now, which again might be a reason why this little bounce that we saw here, we're not coming off of a washout type of a situation. This just shows the Fed fund futures curve rate, where right now the blue line, they've been decreasing it slightly. And then a week ago, they're just comparing prices going back and forth. And I do this a little different way in the weekly videos that I post. I just show how the percentages have changed from time to time. This is the Fed fund futures implied rate. And this is, we're looking way over on the left. This is where we're at. Whoops. This is where we're at right now, where the latest, this is what do they think the interest rate is right now? And then what did they think it was going to be a month ago? And they've actually increased the interest rates. And pretty much across the board, the implied rate, it's kind of like implied volatility. It ends up being a lot higher than what the real number ends up being. But it just shows that this chart anyway, is suggesting that interest rates are going to continue to go up. Here's another one looking at risk premium. This is how much are people willing to get into stocks to get that extra return. Well, when this really spikes up high, that can quite often mark a top in the market where we're having some problems. Well, it was really excessive at different times. Actually, this could mark a bottom right here. When we top is when we go way down to the bottom as well. And we didn't necessarily hit an extreme reading, but we are bouncing back up slightly. Looking at the session on Wednesday, we were solid across the board with growth, actually showing some improvement and outperforming value, both with the large, mid, but they underperformed in the small caps. Here's the VIX with the up day. We did see the VIX decline, so there's a little less hedging going on, and we actually closed near the bottom of the bar on the VIX. And here's the VIX of the VIX, which also showed a decline in Wednesday's session. The fear gauge here, called the Ulcer Index, it's still going up slightly. And this is just indicating that there's still a lot of fear in the market. We're down 17.41% from the all-time high. And this is a little interesting, where on an up day, we saw the put-call ratio actually advance. And then overall, it's still continuing to decline. We haven't gone high enough to necessarily generate a new signal yet. That's when we get above 0.8. But it is starting to come back down now. And I'll have the longer term chart to show you here in just a moment. Here are the pivot points for Thursday's session. And then here's the chart that I've been focusing on more, where we did come down to this trend line, which is right at about 3,900. And we bounced up off of that. We still have the 50-period moving average above where we're at. We still have a previous pivot level still above where we're at. So there's some overhead resistance. If we can break through these, then that would turn the technical picture a lot more positive. And down at the bottom, we were just slightly above average with our volume. And here are the pivot points for the whole month of September, updated with the open candle for Wednesday's session. Here's one of the fib charts where we go to the low set in June to that run up that we saw in August. And then we've retraced down to 38.2%. And now we've been bouncing up to that. And we're right back at about the 50% retracement level. So this is really short term that we're looking at right now. Here's a longer term chart, which shows that even if we do continue to go up, we have some pretty significant resistance above where we're at currently. The sector, since we had an up day, the utilities did the best, followed by discretionary, which has kind of been sneaking up and doing a little bit better these days. Materials did well. The only sector that was down was energy, and that's the sector that's been doing the best lately. So it took a bit of a hit as some of these other sectors that have been struggling saw a little bit of love on Wednesday. Here are the scooter scores showing that utilities and energy and staples, these are more defensive plays. They're into the 90s as far as their technical analysis rating. And we have communication, which is still below 10 at 9.6. Here are the sector charts showing that energy is still doing the best, followed by utilities, with all of the other sectors being negative since the all-time high. Here is an updated chart of how the indexes have performed since the S&P made its all-time high back in January. Our technical alerts, we had some positive, some negative. Canada had a little bit of trouble. They went below 19,000, but the NASDAQ went above 11.6, 11.7, 11.8. Where we generated a negative signal yesterday when the BPI crossed below 50, well, it went back above 50 in Wednesday's session. And then oil has had a bearish, basically a death cross right now with its moving average crossover, and it actually dropped below 85, and the dollar still continues to just do really well. Okay, looking at the different indexes. So right now, even though this is a bad score, the mid caps tend to be doing the best, followed by the Dow, and then the S&P in third place. And none of these scores are worth bragging about, but they did show some improvement. Small caps are still not doing all that great, and the Qs are in last place right now with the major indexes that I chart here. So intraday, we had a positive open. We went up to R1. We danced along that level for a while. And then eventually we saw buying coming back in, took us to R2, and we even went above that. R3 was way up here somewhere, so I didn't put that on the chart. And then we closed just slightly off of the high in the session. Our trend, because of the up day, we saw the red line coming down and the green line coming up. So the ADX is turning down just slightly, but it's still above 20. And the red line continues to be on top. So that's a negative trend, but it could be weakening now. The Arun also saw a little bit of a decrease in selling, but also a decrease in buying. It was pretty much flat from the previous day's reading. Looking at breadth, saw a bit of an improvement based on price, and this was a nice up thrust day. When we go above this line, that means it's pretty positive. We also saw a nice upward thrust with volume. So this chart is also showing some improvement. The advanced decline ratio, after almost going extreme negative, has shown some rebound technicalities right now. But the new highs and new lows, even though we saw a little blip up in the new highs, it's going to take a while for the 5 and the 10 to turn up. Accumulation distribution, it showed some improvement, but is still below a declining moving average. Short term, we saw a change with the decision point scorecard where the intermediate term has now switched to negative, where we still have the short term either neutral to down, and the long term continues to be down with their automated signals. On one day, because we saw that really upward thrust on the advanced decline line, we may have overdone it for the time being. And then looking at some moving averages, just because we haven't seen these in a while, we're still underneath even the shorter term moving averages in this chart. And I have the other moving averages to show you later on, where we have a lot to go just to get back to some of these moving averages right now. So if we do continue to go up, this green line here, this is the 50-period moving average, the simple moving average. It may act as overhead resistance. Stochc RSI trying to give us now an official oversold indication because it's coming out of being extreme negative, as is the Williams percent R. And these are pretty touchy indicators. That's why I put them in the short-term category. The force index, it bounced up a little bit. It's still negative overall, but it's coming back to the midpoint of the Keltner band currently. The Swinland Trading Oscillator, after going extreme negative based on price, has bounced up, and it's also turned up based on volume. McClellan Oscillator, after being extreme negative, has now bounced up. The 20-period exponential moving average, after being extreme negative, has gone up. We saw an advance with the 50, and we're turning up with the 200. Stochc RSI, starting to come out of giving us an extreme negative reading, turning up slightly with the intermediate term, but still declining with the longer term stochastic. Here are the intermediate term moving averages where we have a ways to go just to get back into the rainbow. The Sean trend meter ticked up ever so slightly in Wednesday's session. The PMO, really no change there. It's still decidedly negative. And our study shows that the PMOs that are rising after being extreme negative is showing some improvement, maybe bottoming out with the buy signals and still declining slightly with those PMOs that are above zero. The Chaikin oscillator is showing some improvement. Chaikin money flow also showing some improvement. Volume, it's starting to come up a little bit because we're seeing the volume pick up slightly these days. But the vortex, even though it declined with the red line and advanced with the buy line, these are still really far apart. So that's still decidedly negative. The summation index based on price and volume, they continue to decline. All of our oscillators continue to be headed lower. The BPI, where it just barely dropped below 50, well, it went back above 50. And that was one of the technical indicators, technical alerts. Ease of movement, 1 period showing some improvement and turned up slightly with the 14 period. Ultimate oscillator also showing some improvement. Money flow turned up slightly. The CCI 14 period, it's now given us an oversold reading and it's bounced up. If we have another up day, I probably won't show this chart again. Same thing with the 20. It's just barely below and it's just getting ready if we see more of an advance to give us an oversold indication. The RSI is turning back up for 14 periods and with the 9 period. Again, if we see more follow through, I probably won't continue to show this chart until it tells us something in the future. Here's the 19-day exponential moving average where we had gone pretty low, not quite down to the red line, but saw a nice bounce based on price. And we actually did go a bit extreme based on volume and have seen a bit of a bounce here. So that could be something positive to latch onto, but we need to see follow through to the upside. TTM squeeze continues to decline, even with the up day. Balance of power turned up slightly with the bounce that we saw. This could be interesting. And this is not a chart that I show all that often, but we were getting pretty extreme with the CMB composite index. And that's why I brought this up, because a lot of times that may mark some kind of an oversold condition. Well, when we turn back up, of course, that's a nice little bounce, but now we've crossed above this moving average, and that actually generates a signal. That's a moving average crossover signal for this trading system. And so this could be generating a buy signal right now. Now, I would not use this in isolation. I would use other charts and to reach a consensus of what's actually happening, but this is looking a lot more positive than it had been. Our charts, we see more of a doji type candle right now with the Heikin Ashi, but it's still dark. It's still negative, where the Kegi continues to be negative. Renko continues to be negative. 3-line break continues to be negative. And we're not getting anything new on the point and figure chart. But the last thing that was generated here was a high pole reversal, which are all these zeros going down, which we have to take that more as negative. The elder impulse for the S&P has switched back again to neutral, as it has for the SPY. The SAR system continues to be negative with the dots on top, and we're still at a no-go with the go, no-go system, so that's negative as well. Long-term, here's our longer-term moving averages, where we're just fighting to come back up into some of the moving averages currently, and that would be the 50-period moving average, and we're not even there yet with prices. Our 50-period simple moving average study is turning back up slightly, as is the 150 and the 200. Our special K still continues to decline. It takes a sustained move in one way or the other for this oscillator to change direction. The diamonds have gone back to neutral. They're still in neutral land currently. With the Dow, it came down to this previous pivot point and then bounced up off of that. But we have a ways to go just to get back to the 50-period moving average. The Qs are still neutral as well and showing some improvement, but still a long way to go for these charts to show some improvement. The Vixen declined with the up day, both on the bar chart and on the line chart. And the NASDAQ also had a nice little bounce here, but nothing really has been solved at this point. The mid caps, this is a little more exciting and probably why the mid caps are doing the best right now. They came up all the way to their 50 period moving average and closed right near that. So we want to keep an eye on the mid caps. We were watching them on the way down and that let us down. Let's see if they continue to have some upward movement. Is that going to bring the rest of the market with it? The Wilshire, also nothing really decided, even though we saw a pretty nice bounce. The dollar actually declined a bit, but it's still in this just monster uptrend currently. And here's the S&P to the dollar, still having a pretty strong inverse relationship. So if you're watching the dollar, whatever it's doing, the S&P is having a tendency to do the opposite thing. And I watch the US dollar index. Gold, after having a couple of down days, bounced up over 1%, and silver was up 2.78%, but still in an overall downtrend. Oil, and this might be what we're finding some hope with, at least on a consumer level, where we're really dropping now with oil. We're down to 81.94. And the correlation between the S&P and oil is still, they're having a tendency to go in the same direction now. Looking at bonds, we were up, yeah, but we need to see a lot more than what we've seen. We're still dealing with breaking the COVID low with the world bond index. And then the correlation between stocks and bonds is still tending to be pretty high currently. As far as our yields, we have the 10 to the 5 that's still inverted, the 10 to the 2, which is still inverted. We're still keeping an eye on the 10 to the 3 month. It never has gone inverted, but we still want to be watching that. The tech sector to the 10-year yield, they're having a pretty strong inverse relationship. And yields actually came down, at least the longer term yields did, where the shorter term yields went up on Wednesday. Our scenarios, just looking at these to get an update, a little bit of a bounce with the stocks above their 200-day simple moving average, a bounce with those above their 50. The mid caps, a little bit of a bounce, and the small caps, also a bit of a bounce, but no new signals have been generated yet. Seeing a little bit of an improvement with the 10-day average of the highs and lows within the S&P. And then we're still showing overall weakness with the highs minus the lows, looking back 5 periods when you take the Amex, NASDAQ, and NYSE into consideration. And then this is the equity put call ratio, where we got pretty close up to this line, but we never did really reach it. And we've come back down slightly with the upward movement. The small caps, this is also potentially another little area of hope. See how we came down to S1 and we bounced up off of that. Now we need to see more follow through here, and we still have a ways to go just to get back to the 50 period moving average. But to have it bounce up off of this support level is positive, but we're still seeing that small caps are underperforming the S&P, which is not helping this chart at all. So the red line is declining as the S&P has been declining. And the S&P to the 10-year correlation, also pretty strong inverse correlation right now. Our sector rotation, a little bit of an improvement with the Qs. Discretionary is actually turning up. This is why I say it's kind of sneaking in there and doing a little bit better, but we're not seeing confirmation. Like with the growth versus the value, it turned up slightly, but still below a declining moving average. And here's the large, mid, and small caps showing a bit of a turn up, but still maybe the small caps are looking a little bit better there. But we want to see all of these going in the same direction at the same time to provide some confirmation. The S&P to the 2-year also having a pretty strong inverse correlation, which means that we're still going up here, and we pretty much have taken out this spike. So now we'll be looking for another spike to be formed at some point in the future. The staples were up pretty solid, and this has just been really weird. The moving averages aren't really sure what to do. We drop below it and then we go above it, and it's just kind of crazy right now. So we saw just a tiny tick down with our staples to S&P 500 ratio. So yeah, this spike is still viable for right now, but we want to see this really decline for that to provide some support to the S&P. So what's our outlook then? The technicals are still negative and they're bouncing from being short-term oversold. The economic report's coming out. It's still a pretty light day. We have jobless claims. That'll probably be the biggest thing that comes out. And then consumer credit later in the day. We have our whole list of geopolitical events. Nothing has really changed here. They're still doing a lot of the lockdowns in China, which could eventually feed over into some supply chain issues. We had some Fed speak on Wednesday. Are we going to get any more? And then the debate about are we in a recession or not. So here are our scenarios. We're still going with the down scenario because of all the headwinds the market is facing. The technicals are negative, but the trend line is holding that we've been watching, and it's bouncing from being short-term oversold. Will that continue? We can't really go with the positive scenario because the technicals are still overall negative. Will that support continue to hold? Now we're above that right now, but if we start to decline, we still want to keep an eye on that trend line. And then we have to ask, is the bounce for real? Is this the start of something or just wearing off an oversold condition? Our scenarios, our rotation, our setups, they continue to be on hold because the technicals are negative overall. And we're not even getting back to any of the moving averages yet. And we are not necessarily sideways now because the ADX is above 20, even though it's weakening, but the red line is still on top there. So it is negative overall. So our conclusion then is the S&P overall continues to be negative, even with the up day. Short term, we're just bouncing from being oversold. Intermediate term, it still could be coming more oversold if we decline from here. And it's not really showing a lot of improvement. And long term, we continue to be negative. So thank you. I hope you found this helpful. And I will follow the markets. And if Thursday ends up being an interesting day, I will prepare a video for Friday.